Hi everybody, this is Todd with the Forex Nitty Gritty Insiders daily video. Hope you're having a fantastic day today. Hopefully your trading is going well for you and you are profitable in everything that you are trading. Want to just spend a minute here talking about profitability, talking about what we consider as successful when we trade. And in talking with people over the years, one of the misconceptions of being a successful trader is that a successful trader has to be right all the time when they make their trades. And for those of you that are in this for the long run, if your goal is to have all winning trades, you're never going to reach that level of success that you want, because it will be impossible to never have a losing trade or never lose money on a single trade that you might be taking. So we have to redefine success or being successful from the standpoint of our profitability, our consistency with our trading. And so for a successful trader, that might mean that you are wrong 90% of the time, or you take losses on 90% of your trades, or 50% of your trades, or 70% of your trades, or only 10%. It doesn't really matter the number of winning trades versus losing trades that you have. What matters is what happens with those losing trades as compared to what happens with those winning trades. If you are winning $10 on every trade that you take, and you're only losing $1, well, you can take a lot of losses and still be profitable. If you're winning $1 and losing $10, well, you can't be wrong very often to be able to be successful. So we kind of need to change our mindset from looking at being successful as the number of winning trades that we take to how profitable we are over time. So just think about that and kind of think about where you're at in relationship to your thought process on how you define your success. Now, in the market today, just looking at the stock market, Dow, NASDAQ, S&P 500, pretty flat on the day. Not a whole lot of movement. Europe was up last night in theirs. Gold is down $3. Oil's down 77 cents. So we have kind of a quiet, I guess, day today with what's going on in the U.S. markets here anyway. From a news standpoint, really not a lot happening. We did have some trade balance numbers come out for the pound, manufacturing production in the pound. But other than that, not a whole lot going on with things. We do have this meeting over in Europe with called the ECOFIN meeting, and it's attended by those financial guys from the European Union member states, and obviously they've got a lot to talk about. So when we see things like that, when we see meetings that are going on that are going to affect or possibly affect things, we want to take that into consideration when we are trading. So other than that, not a whole lot going on. As far as what I wanted to talk a little bit about today was just kind of looking at an example of the simple trading method. And of course, we look at identifying the trend. And here is the 40-period simple moving average. If it's going up and the price is above it, then we're going to say our moving average is established to the upside. And you can basically see, we've been making higher highs and higher lows. Well, as this pulled back to some support area, and we can look back here and we can say there's some old resistance, new support in this area. The entry would occur as we start to move above the highest high of the last three. And right there is the highest high of the last three. If this is the current bar, then the highest high of the last three is this one right here. And so that is what we're looking for a setup to take this trade. Now, if we would have gone in here, and I'm going to just put a line right at this area, and just scroll forward, you can see that this would have moved up. And the key from here is there's a couple things that could have happened. In fact, let me just go forward here a little bit further. Let's say that initially we would have placed our stop loss just below the most recent low, which would have been right in here. Well, if we just let this go without having some predetermined target, eventually we would have been stopped out, when in fact we could have had a profitable trade. Now this is a 15-minute chart, so it's not a huge amount of movement here, but it ran up, 14, 15 pips. And so as we start to look at that, we want to make sure that we've got some defined target to say this is where we are going to enter and this is where we're going to exit a trade. And one way that we can do that is we can go back and we can look at prior highs. And so we could go back here and we could have said, now that we've got our entry, which is right here, our stop at the bottom line and our target at the top line, you can see we'd have gone up, hit our target, and been out of that trade, or at least partial position. We may have moved our initial stop to break even and then gotten stopped out on that second half there. But if we just let it go without managing it from the standpoint of having a target, we are going to miss out on some potential opportunities for getting out before it starts to move back down. So take a look at that and make sure that you've got that down. And if you have any questions about what we've talked about, feel free to let me know. If not, have a great rest of the day, and we'll talk to you soon.